Hello and welcome to the National Press here. Bonjour et bienvenue au Théâtre National de la Presse. Je m'appelle Elizabeth Thompson avec iPolitics. With us today we have Governor of the Bank of Canada, Stephen Poloz, and the Senior Deputy Governor of the Bank of Canada, Carolyn Wilkins, who will be speaking about the Financial System Review. Bonjour, et on a avec nous aujourd'hui Stephen Poloz, le gouverneur de la Banque du Canada, et Carolyn Wilkins, le premier sous-gouverneur de la Banque du Canada, qui nous parleront de leur revue de la système financier. Governor?
Oh, thank you, Liz. Good morning, everyone. Bonjour tout le monde. Carolyn and I are happy to be here today to talk about the June issue of the bank's Financial System Review, which we published just this morning. The FSR highlights key financial vulnerabilities and the potential triggers that could turn those vulnerabilities into risks to the stability of the Canadian financial system. To be clear, the FSR is not our prediction of the most likely outcomes. Rather, what it does is to identify vulnerabilities and the triggers that could expose them. It judges the probability of the key risks occurring, and it evaluates the potential impact should those risks materialize. Les analyses contenues dans la RSF sont un complément des travaux présentés dans le rapport sur la politique monétaire. Elle jette les bases d'une discussion détaillée sur la politique monétaire à l'intérieur de notre cadre de gestion des risques. La stabilité économique et la stabilité financière sont interdépendantes. C'est pourquoi nous devons envisager les risques qui pèsent sur les deux de manière intégrée. Permettez-moi de vous fournir des précisions à propos de l'effet de la baisse des prix du pétrole sur les risques liés à la stabilité financière et les risques en matière d'inflation. As we discussed in the January and April NPRs, the oil price shock posed a material downside risk to our projected inflation profile. We responded in January by lowering our key policy interest rate. This accomplished two things. First, it reduced the downside risk to inflation by helping bring the economy back to full capacity over our projection horizon. Second, the cut helped to mitigate the risk to the financial system by addressing the drop in incomes and employment caused by the oil price shock. Now, since then, we've seen a modest pickup in household debt, as well as a slowdown in income growth. In today's FSR, we note that the vulnerability related to household indebtedness has increased. Our analysis shows that debt-bearing households in oil-producing regions are more likely to be vulnerable than elsewhere. But while the oil price shock has had a negative impact on Canadian incomes, it's our judgment that it won't undermine the stability of the financial system as a whole. The effect of the drop in incomes from the oil price shock should be partly offset by a number of factors. These include cheaper gasoline, stronger U.S. economic growth, the lower Canadian dollar, and the impact of easier monetary policy. Another key vulnerability that we're monitoring is imbalances in the housing market. Housing is important to the wealth of many Canadians, and their net worth is affected by a decline in house prices. In recent months, resales and prices in the Toronto and Vancouver areas have continued to increase, while markets in most other parts of the country have been moderating. La croissance des prix des maisons a un peu ralenti à l'échelle nationale. Elle reste toutefois plus forte que la croissance des revenus, et la surévaluation dans le marché du logement au Canada demeure une préoccupation. Malgré tout, il est peu probable qu'une forte correction des prix des maisons se matérialise. Les conditions d'une grave récession et d'une hausse marquée du chômage ne sont pas en place. C'est pourquoi la Banque prévoit encore que les déséquilibres dans le secteur des ménages et dans le marché du logement vont diminuer à mesure que l'économie va s'améliorer. In sum, we judge that the vulnerability associated with household indebtedness is edging higher, and the overall risk to financial stability in Canada is slightly higher than it was at the time of our December FSR. At the same time, we shouldn't forget that there have been tremendous reforms in the global and financial systems, the global and Canadian financial systems that have been designed to reduce the likelihood and impact of future turmoil. There is no question that the global financial system is now more resilient, thanks to these reforms. So while risks may have edged higher, safeguards to protect the financial system are stronger than they were before. Finally, I'd note that the FSR contains reports that take a closer look at aspects of the Canadian and global financial systems. This time, there are two reports. The first details the bank's framework for assessing financial system vulnerabilities. Bank staff have developed new ways to identify, monitor, and evaluate vulnerabilities, which will enable us to assess them more effectively. In the second report, bank staff examined Canadian open-end mutual funds, a popular investment vehicle. What the authors found is that while these funds don't represent an important vulnerability for the Canadian financial system now, it's worth continuing to monitor the sector. I encourage you to take the time to read these reports. And with that, Carolyn and I will be happy to respond to your questions.
Okay, questions. Gordon Eastfeld, Financial Post.
Good afternoon, Governor. This is Deputy Governor. You're talking about the factors that have impacted by cheaper gasoline, and you're sounding optimistic about that impact, possibly a limited impact from where we are right now, and that has to do with the U.S. economy helping out, which we have no real effect on, lower Canadian dollar, which we know the Bank of Canada has no effect on, and easier monetary policy, which we know you do have an impact on. Where is the safety net in those outlooks? We have two very uncertain situations.
Well, it's true that the situation is a highly uncertain one. And it's not just because of basic macro inputs being unsure, such as, what are consumers doing on both sides of the border, what are exporters doing. Those uncertainties are always difficult to read. But we're dealing with a shock which has a number of channels of influence on the economy, which is the oil price shock. And some of them happen to be positive ones, but as we know, the immediate ones are negatives. And so that analysis is much more difficult than we have in a normal situation where the economy may be just a little weaker than we expected or a little stronger than we expected. We usually go to demand indicators first and try to figure out, what's not meeting. So you're right to put your finger on uncertainty, and it's why we are quite clear that we operate within what we call a risk management framework. So this is not a very precise business, but it is to try to identify the potential downside and upside risks and ensure that policy is positioned in such a way that we've balanced them. So in our forecast, those risks are balanced when we publish them. And then in that sense, we can position policy along with each MPR in such a way that it is reflecting that analysis and balancing those risks. So there's just as much downside protection as upside protection as we normally have in such an uncertain situation.
Just one other question. I guess CTV isn't here, so I'm going to ask a household debt, household prices question. How would you characterize the household debt situation right now? Are you okay with it at this level?
So what we know is that it's there's more debt relative to income in a macro sense than we've ever had before. We believe we understand how we got there. We've been fighting a very big global shock based on the global financial crisis, and using monetary policy to stimulate the economy to offset such shocks causes people to borrow more than they otherwise would. That's why we do it. So it's as if it's what you're describing is a side effect of the primary mission, which is to keep the economy on track and keep our inflation targets within their zones. So are we concerned or preoccupied with that? Yes, we invest a lot of analysis into this. But one thing we do know is that over the course of the years, we've had some macro prudential changes to how this all system works. And we're comfortable that those changes have done a lot to make sure that the most fragile or the most vulnerable of those in that borrowing space are in effect being protected or have been prevented from excessive borrowing. So when we look at the situation today as opposed to 3 months ago, we know there's more debt today than there was 3 months ago, 6 months ago. But we don't normally think of it as an indebted household taking even more debt because interest rates are a little bit lower. Rather, what we think of is that there's one more household that decides, well, I can make this move, and I'm going to buy a home now. And so it's an unindebted household that becomes indebted when they buy that house for the first time. And so the data show a rise in indebtedness for the household sector as a whole, but it doesn't mean you don't picture that individual household becoming more and more at risk. It's important to keep that kind of aggregation idea in mind. So yes, these things give us concern. That's why we analyze them as vulnerabilities. It is a vulnerability as opposed to a risk, because what would make it into a risk would be if something seriously negative happened, such as a widespread rise in unemployment, job losses, those kinds of, like a recession, in other words, is the kind of thing would then cause the recession impulse to be magnified by the effects of this indebtedness and people having trouble managing those debts. But we don't see those preconditions here, so it's just a risk that we identify as potential if a trigger came along.
Leah Snur of Reuters.
Morning. The risks that you've outlined overall in the FSR, do they make you more inclined to ease monetary policy or to tighten in response? Well,
as we outlined in our risk management framework some time ago, when we're in a zone of what we call balance or neutrality, that is to say, where the uncertainties about the future of inflation are weighted against the uncertainties around the impact of financial stability risks, we try to balance those risks when we find ourselves within that zone. So implicitly then there can be a trade-off that you would say, well, if I had no doubt about this, then I might be more inclined to raise rates or lower rates to meet this issue. But since I'm not certain of this, then I have to balance the risks as opposed to just taking a direct mechanical type action. So what happened in January was a risk was realized, which is the oil price dropped, and that meant that we were moved out of that zone of balance or the zone of neutrality. And so our primary mission is to get the economy back on track to meet our inflation objective and not be somehow changing that objective because we're concerned about these other risks. We need to get back in. That's our primary mission. And, once back there, then that conversation again becomes one of balancing the risks in the future. So that's a long way of saying it doesn't cause us to think about that either way, that the real place we would do that would be in July, the next NPR, when we have a fulsome update of where we are relative to our inflation objective. And so today, this is just the in between NPRs, and it gives us all the fuel we need to make that discussion fully concrete.
On the housing market, you talked about the trifurcation of the market right now. Does that make it inherently difficult to know how to respond from a policy standpoint?
Speaking as a macro policymaker, yes. It would be easier to understand what was going on if it was the same everywhere. And that's our job, is to look at things from a macro side. And we would use those regional details to help us understand what that macro reading is. Carolyn, would you like to elaborate?
Sure. I mean, clearly from an inflation point of view, we're looking at the macro side. When we're assessing the risk to financial stability, it's quite important to look at different parts of the market, especially when it comes to housing, because each market, regional market, could be behaving differently. And so what we're outlining is the fact that there are areas where things seem to be slowing, easing quite nicely, other areas that are experiencing a little bit more weakness because of the oil shock, and then, of course, Toronto and Vancouver that are showing some strength. It's important there because if it's a generalized thing, which we're not seeing, then that's a different problem than if it's localized.
Paul Vieira, Wall Street Journal.
Good morning. In the page 5 of the review, you talk about the macro financial conditions, and you acknowledge the contraction in the first quarter, but you state nonetheless the Canadian economy is still expected to rebound in coming quarters because of anticipated strength in the U.S. and supportive financial conditions. Does that mean that your outlook for the second quarter and the second half of this year have not materially changed since even with the first quarter result?
Okay. Well, let me first say how proud I was of the bank staff who forecast 0% growth for Q1 back in early January, which was a very far from the consensus at the time. And there's no question that growth was even less than this, but that was a brave call, and it's based on the complexity of the forecast. A very hard call to make. A little less than expected. I would say not materially. It's in that sort of plus or minus 0.5 kind of zone that we think of. But I have to say we have a lower starting point going into this next forecast. And the trade data, the international trade data, were certainly not as strong as we might have hoped. They were, in fact, a little disappointing, I would say. And it's a good reminder in that context, though, that this horrible winter that we had didn't end on March 31st. There may be weather effects throughout the data that go longer, possibly into the second quarter. And certainly on the positive side, the labor market data have been very impressive. So that's encouraging. So we've got things, of course, on both sides of the fence here. It's a complex shock, as I described before. We're at work now on the next forecast, which is leading up to July 15th. So I don't want to prejudge that. I'm just asking you to wait until we've done the full job on it. And certainly the comment in the report today is essentially meant to repeat what we said in the April NPR. So it's not updated in the sense of a new forecast.
There was a section in the financial system review about the risk or the vulnerability, I'm not sure which one, of higher global bond yields due to some reaction to central bank policymakers. In fact, last week, German bonds rose significantly, even though Mr. Draghi was sort of reiterating the sense that they're going to maintain this program and do more. Is the movement in global bond yields and if this volatility continues, is that going to would that prompt the Bank of Canada to at least mull additional insurance, as you put it, and another rate cut if it offsets what you're trying to do in getting the economy back on track?
So, I mean, by volatility, I take it you mean rises.
Right, yeah.
Because there's obviously that's a complex question because volatility appears to be getting into a more normal kind of range, two-sided kind of range. And so we have to try to separate that from whether or not, higher bond yields will have a feedback effect on our economy. Those of course, global bond market developments affect our bond market, not one for one typically, but they're highly correlated, and that's normal. Bond yields today are significantly lower than they were a year ago, despite a backup. So businesses don't make their decisions on a dime. They're much more gradual and thoughtful about those kinds of decisions. So that's a long way of saying that those things have to be fed into our forecast work. And then the question that you posed would be posed in its entirety in our July discussion. But at the same time, the mix would be quite variable. So I would just mention, yes, bond yields may have backed up in the last few weeks. Oil prices have backed up in the last few weeks. They're now above what we assumed in April, like by $10 for Brent and even more for WCS, Western Canada Select. So those would they be sort of positive things to the outlook. The dollar is, of course, because of that, no doubt, higher than it was assumed in the April NPR, which would be a negative. So all those things with all those moving parts, we're not going to prejudge that analysis. It's a very complex job to put everything together. The bond market volatility is interesting from a broader perspective, which is, as I mentioned, two-sided. Carolyn, do you want to touch on that?
Sure. I think, as you say, it's the volatility's part of a normalization in markets, and at the same time, what we're seeing is perhaps in some areas a little bit less liquidity, or market liquidity than we had seen before, and that's perhaps adding to it. It's kind of a natural response to some of the regulatory changes that we've seen that have changed the incentives to make markets, and as well as some other structural changes in terms of growth in asset managers, so buy and hold behavior of asset managers or sovereigns. And all these factors together kind of have a natural implication for volatility. Whether or not how that translates into yields at the long end, so long yields, is something that we're going to see as monetary policy normalizes. But at this stage, it looks like nothing that would be of a major concern, just something that we need to be aware of and think about in the vulnerability or risk space.
And we have a discussion paper to take some moves on our own front to, if at the margin at least, improve liquidity in those markets from our perspective. But that's, again, we're in a whole new world now of regs and what everybody's holding, and so it's almost like you need this kind of test drive, and that progress towards normalization is bound to be a little bit uncertain, especially as market positions get destacked, adjusting to more two-way trading.
Greg Quinn, Bloomberg.
Good morning. Wanted to ask about Greece, since you touch on it in this report. Can you elaborate a bit more on why it appears to be the case now that a Greek default is more likely, and at the same and at the same time, that if there was a default, it would cause less spillover damage in Europe and in Canada than in the past?
Okay, well, I wouldn't want to make a position on whether or not it's more or less likely. Those discussions are ongoing, and we watch them with considerable interest, but from a distance. But in terms of the fallout, in the event that risk were to materialize, certainly we've seen on the macro front an improvement in the European outlook. We presume that comes from lower oil prices. It's an important boost there, as well as the quantitative easing process, which is beginning to bear fruit. And of course, in a process of that, the euro itself is weaker, which again is buttressing that. Lower interest rates, lower euro, and of course lower oil prices seem to be making their contribution. So with that kind of macro backdrop improving, you just have to believe that almost any kind of shock that happens would have a smaller effect than it would before. Plus, I think there's been a lot of market adjustment to that risk, and so markets are at least prepared for it. They're positioned so that they've minimized what sort of fallout there might be, and I think that should be about it. Have I missed something?
Well, I would just add to the point you made earlier just about the structural reforms that have been made in Europe that certainly mean that banks themselves and financial institutions themselves in Europe are better able to withstand any kind of shock that would come. That's pretty important.
Right.
Secondly, the report mentions that some of these risks or vulnerabilities Canada have edged up, but at the same time we're discussing an oil shock that shrank the economy in the first quarter and had pretty widespread effects. How is it that we can see so much damage on the real side of the economy and and just a slight change in the financial risks to Canada?
Yeah, well, that's a good question, and we'll happily admit that we don't have a full reading on the oil price shock yet. As I said before, I commend the staff for doing a good job on that first quarter, but the next step is in fact trickier because the dynamics underneath it need to be understood fully. It's only early days. Actually, we have a couple of readings on Q2 to think about, but over the next 4 or 5 weeks, we'll be doing our real homework. And I think that for now, it does appear to be reasonably localized. It's not totally localized, so some of the negative readings that we saw over the last few months in manufacturing are clearly fallout, and they touch all areas of the country. It's not just a local thing. But so far, the income and employment effects appear to be fairly localized in housing and those kinds of things. So, but it all kind of hinges then on the next part of the dynamic is what do firms do, given what how oil prices have been evolving, and what are their longer term expectations for this. Do projects get postponed or canceled entirely, those kinds of decisions, or postponed for a year versus 6 months, or all those things are things we simply can't predict. And so in many ways, we'll be monitoring this shock for some time. We're simply not going to be able to call it and say, therefore it's. But right now, our premise, as we talked about in April, is that it's mainly upfront. It was pretty rapid. And it's, of course, in effect, permanent. That is, you reduce those investments permanently, or at least for the forecast horizon. And then what we're monitoring is the other things that are still seem to be, then anyway, and still now I think doing okay. We've got signs of growth in various parts of the economy, which is a question of when do those things reassert themselves and become the dominant trend in the economy. And we have to watch things as things unfold in the second quarter and further down the road. So, as again, we'll give you a much clearer picture as best we can in July.
Andy Blatchford, Canadian Press.
Yes, Governor. I was curious. You're talking about the second quarter. I was wondering what your assessment is from the handoff data that we saw to the second quarter, and also what we've seen so far from the second quarter.
Yeah, well, so we won't offer you a running commentary except what I said before, which is the handoff is clearly a negative one. It's less than what we had put in, but it's not a big miss. It was a good forecast, and so we have to take that and then ask ourselves the question of just asking. So the trade data would be something we would look to buttress that view that the positives are still gathering momentum. And as I said before, the trade data were disappointing so far, and there could be some weather effects still mixed up in that, possibly. Perhaps it'll become clearer in the next couple of months. And then, but we've got some good data from the U.S. and we've got some good data from our labor market here. So we have positives and negatives I could throw at you, and I'm just not going to add them up and do the weight of the risk. It just can't. That's just a really big job that we do with the assistance of our models and a big staff. So we're going to have to wait and see.
Also in the report, I noticed you talk about the importance of housing to the wealth of Canadians, especially the middle class.
Yeah.
And I was wondering, we hear a lot about the middle class these days, and I was wondering if you could discuss a little bit about why housing is particularly important to this group, and if you could define the middle class for us, how you define it.
I don't recall saying anything about middle class in there. But
it's on page 10.
Okay, well, thanks for reminding me, Andy. So I'm sorry, I'm not going to get into defining what middle class is, but do you have in mind people for whom their house is their primary store of wealth? They may have other elements of wealth, but they've got a lion's share of their wealth, and they borrowed to pay for it. And so it matters a great deal to them. If it matters more to them that house prices go up or down than, let's say, stock prices or bond yields, because a disproportionate amount of their wealth is stored up in that one thing. So, and I think that's a characteristic that many of us would share. Yeah.
I would just, there's a really interesting study that Statistics Canada just came out that will give you all the definitions that you're looking for, and as well as a lot of data. What is quite interesting when we look at the analysis of financial stability here is that you do see that net worth has increased. There's a lot of debt, but net worth has increased, and so it's important to understand what are really in those assets and are the prices of those assets and kind of at reasonable levels.
Okay. Any other questions? Y a-t-il d'autres questions?
I was just wondering.
Okay.
Sorry.
Andy Blatchford.
Yes, sir. I'm just wondering why you declined to define the middle class. Just, I know it's something, there's many different interpretations, economic, political. Just wondering, yeah, why?
Well, I'm just, you know, I mean, there's lots of ways to measure that and to decide who's the middle and all that. But so I just don't want to get into a concrete definition. I mean, I gave you the one from the asset side, which I think is why housing is a preoccupation for those folks in the middle class, and you know, I think I understand that class pretty well.
Any other questions? D'autres questions? Thank you very much.
Thank you.